We never know where we're going, but we sure as hell ought to know where we are. We're no longer in an easy money environment. If it's the change I think it is, then what you should have in your portfolio going forward can be very different from what it has been.
This is Howard Marks, co-founder of Oaktree Capital Management and one of the greatest investors today. It's no wonder he's built a net worth of over $2 billion. He's known for his investment memos and has recently been commenting on a phenomenon called the Big Change, referring to everything that's happening in the USA right now. In today's video, we'll talk about this big change in the USA and Howard's view on these events for the coming years. Let's start by explaining what happened in the last decades. Everyone got used to almost zero interest rates and easy access to credit. Marx talks about how he believes this low period lasted so long that people forgot what normal interest levels were.
The Fed discovered something called quantitative easing, or the buying of bonds, and it really did a great job of saving the economy on both occasions, but it loaded up its balance sheet with debt.
But logically, these times would end one day. The pandemic arrived, and with it came economic crises in various sectors. There was a high level of money printing, and the low inflation caused the Fed to need to raise interest rates. And that's exactly what Howard talks about. These rates are quite normal now, and over the last 20 years, we've been conditioned to believe that low interest rates were normal. But something important in Howard's memo is that most of these problems we're facing are precisely because in the past we got used to thinking that interest rates of 2 to 3% were normal. But when we expand the Fed funds rate over a long period of time, we can realize that 2% was never an average, but an extremely low interest rate.
And, between 0 and 2 is an emergency measure. And, rates were, the Fed funds rate was 0 much of probably the majority of the time in the 09 to 21 period. And that's inappropriate. It stimulates. You can't live on a shot of adrenaline every morning for 13 years. And it does subsidize borrowers and penalize lenders and savers.
In Howard's view, a rate of 2 to 4% is what would be viable for the Fed to establish, but now interest rates are higher than that, reaching up to 5.55%. And one of the main reasons for this is because the Federal Reserve is very concerned that inflation is not under control. In summary, we had this long period where interest rates were very low. This ended up becoming a pattern we got used to, and now rates are returning to a more normal level. Now, we're taking a hit for being over-leveraged. The mortgage business is taking on too much debt. Anyway, we're paying the price now for staying so long with a low interest rate for so long. So that's our problem. But one thing Howard is more concerned about is how this is affecting the government. We can't forget that while we have mortgages and companies have loans, another major player is the government itself, and they don't get any special treatment when borrowing money. They also need to pay with interest, and they also feel the squeeze when interest rates rise because they need to roll over debts at much higher interest rates. In fact, the US government may be in a bigger problem than ours. Howard said, "We saw people getting very comfortable carrying debt when we were at a low interest rate over the last 20 years. Now, take a look at what the US government has been doing in that time. In the last 20 years, the US government has been running a consistent deficit year after year, and this means they've had to borrow more and more each year just to plug the hole. Now, look at what happened to debt levels since that last surplus year. The debt pile naturally grew very fast, especially in recent years in response to the pandemic, and that's made everyone look at the USA's debt problem."
Several reasons for that, but this period's been quite odd because we then had the pandemic, which led to the strengthening of balance sheets for both corporates and households off the back of a monster fiscal transfer. And a question I think that Lisa and I hear a lot, Howard, is where is the leverage now? Where is the leverage now?
Well, we know that the leverage is in the government, that the government has taken on a lot of leverage as part of its rescue mechanism. We had two serious problems, the global financial crisis to kick off that low rate period you're talking about, and then the pandemic to bookend it. And in both cases, the Fed discovered something called quantitative easing, or the buying of bonds, and it really did a great job of saving the economy on both occasions, but it loaded up its balance sheet with debt.
Quantitative easing is the process of the government selling many bonds to the central bank, known as the Fed, or borrowing even more. Although this has helped economically in the past, it creates a big debt problem for the government, especially because the government still needs to pay that debt to the Fed when it matures. In addition, there's another point that is worrying, and that is not under the government's control: inflation. The government accumulated a large pile of debt during the low-rate period of the last 2 decades. When the pandemic happened and the Federal Reserve intervened to support the government, it simply spent, spent, spent. This means that the government got much more indebted, and now this debt pile is a threat for 2 reasons. 1, because the government can't pay, because they have a deficit, and 2, because when debt matures periodically, they need to roll over, meaning turn an old loan into a new one, which is much more painful at high interest rates, because it means the government needs to spend more money just to maintain that debt, which takes even more money out of their pockets that they were using for other things, and consequently, it increases inflation. This is the problem the US government finds itself in now.
How do you frame that? How do you think about that?
Well, first of all, I don't invest in sovereigns. And the trouble is that in sovereigns, other things matter. They don't, when we look at companies, we ask, do they make money? Will they make money? Will they be able to pay their debt?
Yeah.
Governments don't make money. They're not expected to make money, and they pay their debt by running the printing press. So that's a very different function.
If they've absorbed basically the leverage that existed elsewhere,
Yeah.
and they are less exposed to the challenges of companies that you would invest in, are you thinking of a much longer cycle as a consequence?
Well, I don't think governments can keep us aloft forever, you know.
Howard's and people's main concern at the moment is this: governments helped us a lot during the pandemic, but it came at a high cost with very high inflation, which we now have to deal with through higher interest rates. To give a good impression, in difficult times, the government had to spend money they didn't have. For that, they turned to the Federal Reserve to sell some, but now the Fed no longer wants to buy government bonds because it is an inflationary action, and now the Fed is focused on stopping inflation, so they raise interest rates and do not reinvest in treasury bonds when the old ones mature. Therefore, Howard is correct in saying that the Federal Reserve and the government cannot, in quotes, play with these rates, and that something really needs to change. The same opinion that Ray Dalio has, that the problem really starts at the source. So it's not a great situation in some views, but keeping that in mind, the last excerpt I wanted to reproduce for you is some advice from Mr. Howard Marks, so that we, as investors, can observe with all the problems of relatively high interest rates that probably won't fall much in the near future. Where can investors look for good returns?
The only thing I'm sure of is that if interest rates are higher, the people who invest in credit instruments, which is what we do, are buying in at higher yields and invariably will have higher returns than they have in the recent past. So today's rates are not high historically, but they're certainly higher than we had from 2009 through 21, which means the returns on credit.
As we've seen, all this turbulence excites Howard. As he says, he invests in credit tools. So as interest rates rise and become higher, investing in loans becomes more profitable. Interest rates are higher, which means you receive more interest on borrowed money, and this makes it harder for stocks to thrive and consequently for companies due to lack of funding. I advise you to watch the video I made last week about Warren Buffett's vision for 2024, where he gives similar advice. What do you think of all this economic repercussion that's happening? If you enjoyed the video, don't forget to subscribe to the channel to follow the upcoming content. Thank you and see you next time.